You can never be too rich or too thin. That's a quote that's been attributed to Wallis Simpson, whose third husband was the former King of England. She became known as the Duchess of Windsor. In any case, there are circumstances in the securities world where you can be. We're going to talk a little bit about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about stocks, options, investing, the markets, take your questions, and all that kind of stuff. We have had a couple of sectors that have done remarkably well so far this year. I think in many cases they deserve to do well. Some of those same ones that have done well this year since the beginning of December also did well today. Just by way of example, I'm going to quickly pull one of those onto the screen over here so we can have a look. What we're going to look at here is just the performance within the S&P of the various sectors today. So you can see that overall the S&P was up 47 basis points. IT, information technology, always talked about, that was the best performing group. Okay, fine. That's not really what I was talking about, though. The second best performing group here is materials. And this is an area that has done remarkably well over the course of the last, we'll call it 2.5 months or so. And as I said, there were a lot of sectors that got left for dead. And we talked a little bit last week about sector rotation. The question that I think is worth asking ourselves, though, is whether from time to time you get into a circumstance where maybe even just for the short term, something has indeed gotten a little bit overextended, rich, if you will. And one way we can observe this potentially is by taking a look at how a security or a sector or an industry is behaving relative to its sort of long-term trends and its longer-term moving averages. So with that in mind, I thought we might take a look at this one relative to. So I often will start with a 1-year chart simply because it works by default. Then I'll go to a 5-year chart. And this is a 5-year chart. And you'll notice that there have been circumstances in the past where materials have gotten, well above the 200-day. So this is an example right here. And ultimately it went higher, but not before sort of, falling back to the trend, if you will. We can see that over here. We can see that over here. And as we look at where we're at right now, we can see that as a sector, materials have gotten quite far above the 200-day. That's the one in yellow. The 100-day, that's the one in green. The 50-day also here. And I don't know, I've alternately called that pink or lavender or something. Well above. So I thought, well, why don't we quantify that? And number one, look at the relationship of the price of the XLB materials ETF relative to its 200-day moving average and see how it behaved historically in similar circumstances and whether this is something that's worth thinking about, right? So to that end, first things first, in here, and I'll blow this up a little bit so everybody can see it a bit better. So this is just going back to December 1st. Over here on the right, I've ranked best to worst. The performance of the various sectors since December 1st of last year. Highlighted in yellow is the S&P more broadly as represented by SPY, the ETF. So over that period of time, as you can see over here, S&P's up total return basis of about 2.4%. Materials and energy and the regional banks are all up considerably more than that. So as it happens, over the course of the weekend, I was looking at the materials sector. And as I was doing that, I thought, oh, okay. And you can also see it's one of the best performing sectors over the course of the last 5 days. So up over 5% in the last 5 days, only energy outperforming. And I thought maybe we could go through this as I sort of work through this myself together and see if we can come up with any potential takeaways. So this data set that I have for us here now, I don't like showing just rows and columns and numbers because I feel like it doesn't really inform very much, but I want to tell you what it is I'm looking at anyway, and then we'll just get some numbers to spit out and see where we land. So in this table, obviously I have dates here on the left. These dates you might immediately observe are not in date order. I have the prices of XLB over here. I have the 200-day. I'm going to put dollar signs on this so that we can get a sense. So this is the 200-day moving average over here in column C. This is the last price of the security in column B. In column D is the price divided by the moving average. And I'm going to show why I think this is important. And I'm kind of going through this exercise live with you so that this is something that you'd be able to do at home if you liked. And we're thinking, okay, because you can see I'm just using Excel, or you could do the same thing in Google Sheets, presumably, or whatever Apple's variation is. The only thing that you really need to have in this case is the last price, so the historical last price of the security. Everything else could be calculated, including the 200-day moving average, because if you have the entire history of the security's last price, which dates back, I think, to 99, or I'm not sure when, then you can calculate the 200 days as soon as you have 200 days worth of data, right? So let's see here. Hang on one second. Sorry. Just have Bloomberg pinging me on the other line. So by doing this, what I'm going to be able to do, because this is really a percentage, right? So this right here is just the relationship between the current price and the 200-day moving average. If this is a very low number, that means that it is very depressed relative to its 200-day moving average. And if it's a very big number, it's high. So what I can do then is I can just rank these, rank sort them. And let me just make sure that this next column is, I meant for this to be empty because I knew we would be doing this. And why do I have blank cells over here? What, should there be blank cells over there? Oh yeah, that's okay. All right. So this, by the way, of course, indicates instances where there was no 200-day moving average because this dates back to 99. There weren't even 200 days of trading history. Okay, so I can just do this. And now I can just basically come up with a ranking. As we can see, there's 6,824 instances. If I want to just get a percentile, I can divide by the number of instances that we have here, and it's going to give me some numbers like this. So this is rank. This is the percentile. Okay. Now over here, these fields right here, which I will now put in bold and underline like this. So this is the 30-day, 30 calendar day, 60 calendar day, and 90-day average returns for XLB, right? So we can see that on average, since the security was first listed, the average 30-day calendar day return for XLB is 60 basis points. We can see that the 2-month is 122 and 3 months 177. Good enough? So having done that, my next question is going to be, okay, well, where in this sort of percentile ranking do we exist now? And by the way, just so I don't accidentally screw up a formula, I'm just going to switch that over to be static data, right? So now we know where that is just within the current context. You'd have to do some of this work again yourself if you wanted to refresh it. So one of the things I can do now is I can just go back to the present time if I wish, and get some sense of what percentile we're in. Now this over here, arguably all of this data should probably be the first couple hundred days. Maybe I should just omit that since I don't really have the 200-day moving average. So I could potentially pull that out if I chose. Maybe it's not even a bad idea for me to do that. Probably should have done that before. I got rid of, by the way, you're going to notice over here, I'm looking at forward returns. So these spaces here, of course, we don't know what the 30-day returns are as of January 13th because we don't have February 13th yet, and so on. So there's going to be some gaps that should make some intuitive sense to us. Okay. So having done that, my next step is to say, all right, well, how do these things change then? And you know what I'm going to do? I'm just going to take these values, because those are formulas right there, and I want them to be. I'm going to paste that over here as values. And I should probably put more space in here. And what I'm going to look at now is I'm going to say, all right, well, depending on what percentile it was in at the time, were the subsequent 30, 60, and 90-day returns better or worse? So we're going to just take that minus that. These should all be zeros because we're looking at the full data set now. Good enough. And now we're just going to do a little bit of filtering. Well, actually, before we do that, I should just quickly point out that it's important for us to know where we currently stand. Where are we now? And the answer to that is we are in the almost the 93rd percentile. So let's just break this into deciles and we'll just take a look at what we get. All right? So if I take a look now, if our argument or our intuition suggests that a security can indeed get too rich, too stretched, things are too thin, that actually what you get thereafter is not as good, then what I can do, and by the way, you need enough data for this to actually be representative. So if you have 100 days worth of trading data, you can't break it into deciles because you don't end up with statistically significant sample sizes, right? 100 trading days divided into 10 buckets, you got 10 each. That's, 30 in this context would already be very small. But in this case, we're dealing with close to 7,000 trading days. All right, so I'm looking for things above 0.9. Let's see what we come up with. Uh-oh, and I covered up. I deserve that. So what you may have noticed is that when I did my copy paste with the formulas, I accidentally went over my all right. So these numbers are still the same, but they are the formulas that I now want. So I'm just going to take a look. When we're in the top decile, do these numbers change at all? And the answer is that indeed they do. You can see here that the relative performance in the near term is much more muted. The relative performance longer term, interestingly, just showing that something has a lot of positive momentum, is actually much better. So 90 days, you can see, we're getting better performance. The underlying security sector, whatever it is we're looking at, and again, this is 683 trading days, that performance is better, but in the short term, perhaps a little bit overbought. Does that mean necessarily that that you can't have very good returns? No, it doesn't mean that really at all. But it does mean, and we're going to just take a quick look at a histogram here. I think this is kind of interesting. What it does indicate, there we are, stick a histogram in here. I think we need a couple more buckets than that. Let's do what the heck? Let's do 50 in this distribution. So you're just, you still have some outsized up moves in here, but we are just not as far over as we are. So we're going to be, basically, you can think about it that you're going to be over here, right? So, what to do? Well, a couple of things. What this tells us straight away is that by itself, being extended relative to a long-term moving average, if you have a long-term investment hypothesis, and for those that are buying materials and have been for the last 60, 90 days, one presumes that their hypothesis was not that they were simply going to catch a bid for a like amount of time, and that they are now selling. It's probably a longer-term bet. But when it comes to options, options will expire. And so my thinking was that if one has exposure to the space, you could take advantage of this by potentially selling some upside. So then the next question we want to ask ourselves is, okay, well, how do things look in vol space? And, you know, we like to sell, call it 30, 60-day implied vol, something in that neighborhood. So let's just look at the 2-month vol, and we'll see where we are relative to a 2-year history. Something like that. And we can see right now that implied volatility is up close to 22. Looks like it sold off a little bit today. I first started to look at this over the weekend. But that's still considerably higher than the mean. Right? So we can see down here that this is about 1.4 standard deviations above the mean volatility over the course of the last 2 years. So with all of that then in mind, one approach, if you happen to have exposure here, would be to say, okay, I like the space, but I think in the near term it could be mildly, you know, that the returns are probably not going to be as good in the near term, or that historically, this would be a more accurate way to say it, that historically, when materials have gotten this far above their 200-day moving average, their forward-looking 30 calendar day returns have not been as high as they have been in the long run. But in the longer run, so looking ahead 60 and 90 days, 90 days in particular, we can see the performance is quite good. So one approach here would be, if you already own it, and once again, I'm having that password issue. So let's see. Save that. We'll pull it. Yeah, I just hopefully it saved this time correctly. So, a couple things you could do. If you've been fortunate enough to, let's say, have purchased materials or some subset thereof within the course of the last 60 to 90 days, first of all, great, good for you. You've had very nice returns. What you can do is think about selling some upside calls against that. And one could do that by, no optimal long call, but I'm not interested in an optimal long call. I'm interested in selling a covered call. And I must, do I have the right thing in here? Let's see, XLB. You know what, I'm just going to modify this because I'm not sure. Maybe because we're after hours prices. Go out to March. Look to sell perhaps a... Now, because the thesis here is... Okay, so that must be what's going on. It doesn't have any price feeds. Let's see if it does for the regular ways. If it does not, I have another solution. I'm going to use our proprietary software for that exercise. So I'm just going to look at the March 52.5s, and that is a 50 delta. That's a little slight, so this is the downside in theory of doing something like this after hours when the prices are gone. So what I'm going to do now is I'm going to go back and see where the prices for these things were before the close, maybe around 345. So let's do this. Let me go to... I was looking at the March 27s because I think, you know, that's 6 weeks away, give or take. Not terrible. So let's do this. I'm going to try to find maybe a 30, slightly better than 30 delta call. Let's look at these 56s. Okay. We'll see where these things were quoted at 3. Oops. Actually, another thing I need to do here very quickly is we can do this way. I can go to the March expiration, see give or take what the implied volatility was at the time. We saw that it was around 20, 21, something in that neighborhood. And I can just model that out. And I'm going to look at, let's take the 50, see what the 55, what the 55s would have been. So So 55 calls at, this is not the correct vol, but maybe we'll call it 20.5 would be reasonable. You're going to get about 1%. That seems a little thin. Let's look at these, which are 20 spot 89. That's fine. I'm going to go down a little bit, $1.39 for the 52.5s. My thinking here is that you could sell either the 55s or the 52.5s to create your buy rate. So now I'm going to go over to our own charting application because that's easier for me to manually implement my own prices. All right. And if you don't own it, so this is what you do if you own it. First things first. So if you own it, consider selling some upside calls against it. As you can see here, it's a little bit stretched. Go out to maybe March, and you can sell some of these calls against it, get long the stock. And this price is actually ambitious. You're not going to get that for that option. This is going to be more like $1. Let's just use $1. That's probably a fairly reasonable price. And you're going to end up with a profile that looks a bit like that. I'm going to go up and down 2 standard deviations. You guys know what a covered call looks like. If you don't own it, you can think about selling a cash secured put as an alternative. Now, think back to what that spreadsheet was telling us and also to the fundamental view that we have. So the fundamental view that we have is that the materials trade remains intact. Just because it's outperformed by, call it 15% or so, doesn't mean that it's over for good. It's just that right now it's getting into some stretched territory relative to its 200-day moving average. So we like it. We want to own it. We think it might be a little bit hamstrung in the near term. So if you sell a cash covered put, oftentimes when you do that, the intent is I'd be willing to buy it at a lower level. Think about your call spread risk reversals, which would also be a legitimate thing to do here. So we can model out a trade like that. Same underlying thesis, generally bullish, expecting that maybe over the next couple of weeks that it's, the huge strength that it's shown recently isn't going to continue. But still, the view is that longer term, it's likely to outperform. A call spread risk reversal is also a good setup in this environment, knowing as we do that options implied volatility is a little bit on the rich side, right? So here, what you would do, because again, you want to own the underlying assets, 52.5, you could actually buy those 52. And actually, I don't have these. I'm going to go a little shorter dated. Get rid of this. So you could buy those 52.5 calls, which are essentially at the money, sell something over here to offset it, and then sell some downside as well just trying to capitalize on that elevated premium. Why is that's because it's taking a mid-market price. It's not that. This is going to be probably something closer to 80 cents or 50 cents. I think it was 50. That's what we were looking at before, right? So there's your long call spread, and then you want to sell, some downside against it, like that. Just because it's a little bit overbought in the near term. But the thing is, if you're going to sell a cash covered put in here, use something that's close to at the money, maybe even slightly in the money, because ultimately the objective is to own this longer term. Okay, so just something, a way that I like to look at things sometimes when this is sort of continuing on that sector rotation theme conversation that we were having last week. Okay, so with that in mind, I'm going to go ahead and take a look at some of your questions, if any. There was one other thing. Oh, yes. Planet Fitness. I don't know if we discussed this on the channel. It was a name that I was looking at in November. I did write an article about it. I think we talked about it. Still, it's asset light balance sheet. I think this, and the stock it rallied, kind of held in after I talked about it in November. So let's take a look at this. We're just going to look at a 6-month chart. But it has subsequently fallen back, and they're going to be reporting earnings soon. So, back here in, November, it's when we were looking at it. And it did indeed rally, hit some highs over here in mid-December, got up to about 114. But it has subsequently given back a considerable amount. So this is another, it's a name I think that's maybe worth having a look at because, oops, I don't want year to date. I don't want 1 year. Year's not long enough. So we're getting down towards the lower end of that range, reasonable valuation. I'm wondering whether the reason it's trading poorly is perhaps some folks have some insight into the normal uptick that some businesses like this might receive after the new year. People make New Year's resolutions. I've made a New Year's resolution. Okay, I'm going to try to lose a few pounds. Other people have probably done the same. Probably many people need to do the same because during the holidays we tend to gain weight. I certainly gained plenty. Is part of the reason for this weakness that there's some alternative data out there that suggests that they're not getting the conventional post-New Year's uptick in foot traffic? Well, maybe. So here's some of the alternative data that we've got. Bloomberg second measure, which I have shared with you guys in the past. Not great. But I have also said that I've had very mixed results with this. I don't tend to rely on it. Now, I think it's important that I present it, though, because all of the alternative data providers, AI systems, everything is improving steadily through the course of time. So just because second measure was second best, in my view, over the times that I've used it, doesn't mean that it's not getting better. But I'm just going to throw it out there as a caveat that I haven't personally found that to be so terrific. Here, too, you're going to notice that second measure has decidedly more negative data than the industry overall. It shows the industry as weak. It shows Planet as even weaker. And that is not necessarily consistent with the year-end data. So this is stale, I should point out. You're going to notice that Placer, I do like Placer because what is Placer doing? It's tracking whatever, 10 million handsets. Somebody goes walking into Planet Fitness's location, carrying their phone. They have a huge sample set and they can see that. So apparently they were getting above expected visits in December, but this is still a little bit stale with respect to the data. So, but as we can see, SimilarWeb, their web traffic visits, at least through the end of January, look better than the industry. So they're going to be reporting earnings. on the 24th. Yes. So that's going to be coming right up in about 2 weeks. So I think that's going to be an interesting one to watch because it has gotten relatively cheap. This is a name also because for those that don't know, I am not a member of Planet Fitness, not promoting them in any way, but they have obviously very good top line growth. They run an asset light model, and they have very attractive sort of entry level pricing plans. I think they're the lowest. I mean, we're talking like $15 to $25, which is about a tenth what my health club costs. But this is the Bay Area. Bay Club's not inexpensive. Okay, so FinWest is saying, yeah, I had a Planet risk reversal for January. Yeah, and I believe so. If I talked about that here on the show, the risk reversal that I was talking about in November was the 97.5, 115, 125, something like that. I know it was the 97.5 puts. That's and I didn't know whether I had shared that with everybody, but thanks for saying it. So in any case, the stock has pulled back. Might be an interesting opportunity. If anybody got into that thing, I don't know whether they took it off when they had profits or covered the short put when those things became worth considerably less in mid-December. If you didn't, you own it at 97.5. I don't think that's a terrible valuation, given what the company is expected to do for the full year. So if you own it at 97.5, you own it at least where these numbers are, at 27.5 times full year earnings estimates. Not terrible. Something in the neighborhood of, well, not quite 3% free cash flow growth, but it's growing. So a name to take a look at. Okay. Sicilian Ambassador. Hi, Mike. I noticed FBY paid almost 3 times higher this past week than the previous 3. Certainly not complaining, but do you know why? Volatility, maybe. Yeah. So, for purposes of the live stream, I will probably not talk about, probably not going to talk about the YieldMax family of ETFs too much, not because they don't deserve a conversation, but because we have sort of open forums on them, including the one that we do with Wolf on Wednesdays, which I encourage you to join, and you can certainly ask questions. I will address this, though, because that's a little bit more of a question about Meta, really. And my guess is that what you're seeing is this part right here, which is that we had higher implied volatility going into some results that have subsequently come off quite a bit. So you get higher implied volatility, you're going to get higher options premiums, and you can combine that with decent stock performance. That's what we have here. So over the last month, you can see what happened. Stock got down to this area here, about whatever this is, 528-ish, and then got up now to whatever, 7.25. It's fallen back quite considerably. The stock was higher. So you put those two things together, and buy rates are going to do reasonably well. You're selling elevated options premium, and the underlying stock's going up. It's win-win. That's exactly what you want to have happen, as it did there. Okay. FinWest, aloha, Mike, from a cloudy, rainy, windy island. Good thing you didn't choose this weekend for your holiday trip. Will you be making more use of unusual whales? I'd like to learn about it. Thanks. Yeah, I have said and promised that I would do that, and I will do that. But as you guys have as you've almost certainly gathered by now, I have a lot of muscle memory with the Bloomberg terminal and with the API that's associated with it. So the day that I'm going to do more about unusual whales is when I have more time and fewer meetings coming into the live stream so that I can actually prepare some material and walk through some things ahead of time. So basically it's going to be more canned. Maybe I'll even do a recorded one just so that I don't waste time fumbling around, because it's not that it is harder to use than the Bloomberg terminal. I bet you it is easier in almost every way. But the truth is that just so much muscle memory. If I know I want something in the Bloomberg terminal, I kind of know how to retrieve it. And in this context, since you guys are asking questions, I want to be able to get right to the answer and not have you watch me bumble and stumble around, which I almost certainly would in that case. 7-figure mission. What are your thoughts on Docu? I know the software names have been headlining, but I'm thinking at some point there has to be a rotation in old, beaten up COVID high names. COVID high. Well, let's do this. Why don't we start by taking a look at where this was back then. I'm going to go back a little bit further, so I'll go back to 2019 so we can get a look right through it. You know what? Let's go back 10 years. Is that 10? No. Okay. So what are the lows? Let's get rid of these moving averages. Makes it a little clouded. So we are at 47.59. And the prior low, October of 23, was 38.11. And we got down to about this level here. I'm going to, in round numbers, within 10%, maybe a little bit more, maybe 15% lower. Looks like. Maybe even a little bit more than that, November of 22. But that was after a prolonged bear market generally. Remember, that was the era of rates going up. So a lot of things were getting hit. We got to an intraday bear market, if not a formal one. And then, of course, on the pre-COVID side, down here, actually very comparable levels. Very comparable levels. So now, having done that, let's take a peek at their financials. So what are they expected to do? What have they been doing? What were they doing? So let's go back to 2019 first. Sort of a nice pre-COVID era. We are looking at $700 million in revenues. They weren't making any money. And 46-ish million in free cash flow. It was trading exceptionally rich at that time. So $8 billion valuation, give or take. I'm looking at the enterprise value now. Go into the pandemic and immediately thereafter. So this is really the pandemic year. And the reason I say it's the pandemic year is because you'll notice that their fiscal year actually ends in January, right? So we hit the pre-pandemic highs in February of 2020. And presumably it was in and around this time that things started to pick up and people were doing more remotely. DocuSign, obviously very handy for remote work. So at this point now, we've had almost a 5-fold increase in free cash flow, and revenues have almost doubled in just 2 years. Since that time, they have doubled again. So this is through the end of last year. And one could argue that this valuation that we were seeing back here, $8 billion enterprise value, well, several years on, and the company's got $920 million of free cash flow. So if you had owned it around there, that's pretty handy. Is it the same kind of wild growth story that it was before? No. But this is really next year's anticipated free cash flow number, about $1 billion on an $8.8 billion valuation, which is not far off of where it was before COVID. So, I mean, 11% free cash flow yield, 7% top line growth, 851 in earnings, which means that if you buy it here, that's, I'm going to round that up, 852, 11 times? 11 times forward earnings. What's wrong with this picture? Where do they make all their money that everybody thinks this whole thing's coming undone? So let's start with this. If you didn't know what business this was, but you were able to say, okay, it's an asset-light business with 8% free cash flow yield, trading at 11 times earnings and growing the top line at 7 to 8%, you would buy the stock, right? So there's probably something else going on here. Let's take a look at how they report their numbers. So I have seen, as I'm sure many of you have, there have been some comments about whether SaaS models are slightly broken. I don't know why they would be necessarily. I feel like that's an overarching statement, and it's not entirely clear to me why they would be. But this seems... I mean, is this something that people... I don't really know. I mean, is this something that people think is going to be disrupted by the blockchain? I mean, I guess that would have to be it. Let's see. Subscription services, professional. This looks like this is anticipated to slow. So I'm looking for things where the street's expecting things to come in a little bit. So professional services, they're expecting that to decline. But enterprise and commercial revenue, they're still expecting growth in this area. They're expecting customer growth. And then on, I guess this is, Yeah. Yeah, I mean, I guess it's fair for people to say, look, the COVID disruption, because it forced people to adopt remote technologies immediately. It was do it or die. It is 100% fair to say that that is going to clip longer term growth rates. But you know, you still have the business, right? You just got it sooner than you thought. So you lower the forward growth expectations, but you have, better income revenues now. It is definitely priced. It's not priced for growth to slow. It is priced for growth to turn negative. And I don't know that it will. So, yeah. So, yeah, I'm guessing that there has to be an embedded concern here about disruptive technologies. So that would be what is, number one, as I previously mentioned, is the blockchain going to do something about how DocuSign operates? Will AI disrupt it in some way? And are they unable to capitalize on these changing trends? I will say that longer-term factor analysis suggests that a warning sign for investments' performance over the long run is slowing top-line growth. And we have that, right? So they're going to be reporting numbers soon, and the top-line growth is expected to slow from north of 8 to less than 8. They're going to be reporting on Producer Jay's birthday on March 13th. And it is expected to slow still further for the upcoming calendar year. I'm just going to call it this year because, one extra month doesn't really make that much of a difference. Still, this is if these numbers, even if these numbers are nowhere near as good as this, it does seem to be, at the very least, fairly priced. What do the technicals have for us? Any good news here? So stochastics these two are still short the stock. But all of these parameters are leaning long. Let's just take a look at the moving average envelopes or Bollingers and see what we have. I should extend this out a bit. I would think, well, you're kind of trying to catch the falling knife here a little bit, but boy, it sure does seem like if we are going to find some level of support, that right down here wouldn't be a bad place for it. And we are not far from that now. And if you don't mind being a little early, moving average envelopes and Bollingers, which have had a good, oops, that was well done, have a very good track record over the course of the last several years as a timing instrument. So short version, I like it as a, here are the things I don't like. Below long-term moving averages, we're not quite to, that defined area of support, which is, to my eye, about down another 15% or so from here, maybe a little bit more. But from a fundamental perspective, it does appear to be very reasonably priced. I mean, at 40, you're at $40 ish or just over, you're buying this thing at less than 10 times forward earnings. That's pretty good. So that's my thoughts there. How big is the implied move? Let's just check this one more time. Well, we can't quite see because Bloomberg hasn't been able to do the calc, but that's okay. We can take a look at the March options prices and get a sense of what the implied move is between now and then. 47.5, call it 48. Those are pretty wide, but call it 3.5, $7. So with a 14-ish, almost 15% implied move, if one wanted to play now, then one could sell puts at that level. You're going to have to be careful because I'm guessing that you need to use limits. Let's see how tight those were. If they closed with no bid, they probably didn't even have that much of a market even well before. So let's check 15 minutes before the close. Yeah, look at that. There, you can drive truck through that bid-ask spread, $1.10 wide, even more, $1.13. But sell that thing somewhere near the midpoint and buy an upside call spread, all for a push. Risk is that you're long the stock at 40, which is a multi-year low. I kind of like it as a speculative long, despite the fact that it's obviously below its long-term moving average. Often said, nothing good happens below the long-term moving average. But, it does mean that oftentimes you're getting stocks a lot cheaper than they have been, right? So, Eric, Mike, been a rocky road for PANW the last few months. Is this an attractive entry point? Let's see, is this a similar circumstance? Let's see. Well, this could be an interesting, still a little ways lower, but we're certainly getting there, right? Into this neighborhood right here. That looks kind of interesting. We're not far off of it now. We'll take another peek on a valuation basis. We'll go through the same exercise. Same kind of, well, not so much. I mean, still low double digit growth rates, 433. I'm going to choose the midpoint. I'm going to call it $4. It's not screamingly cheap, but it's not. If we're going to assume that they're going to do something in the neighborhood of $4 in adjusted EPS, I mean, 40 times forward earnings, So I'm basically taking kind of a hybrid of these two numbers, right? So I was just using 4 as my number. So yeah, 166 divided by 4, it's a little over 40 times earnings, but solid free cash flow. I think we can say that. We'll call that, let's say for the next 12 months, we'll call it 4.25 billion if everybody's okay with that. So 4.25 billion gets us to 4% free cash flow yield and growing at 16% per year. That is also good. Revenue growth is decent. So it's not terribly cheap on a price to forward earnings basis, but it's generating excellent free cash flow and growing quickly. Slight deceleration on the top line, which probably is, as I pointed out, that's one of the reasons why you can start to see that performance start to lag. But we've gotten a material. The important thing to think about is that when you have that data, here you're already looking at a peak to trough decline over the last several months of 32%, right? So when you look at data like that says, oh, well, when you see the revenue numbers rolling over, the subsequent 1, 5, and 10-year returns might not be quite as good. Well, bear in mind that if you lose 30% right off the bat, a lot of that damage is already done. And right around that 150 level looks like it could be a potential area of support. So here again, kind of the same thing. Not as cheap as DocuSign, but reasonably valued, and it's a lot cheaper than it was. So, yeah, I think this one's okay too. Let's see what vol looks like. Oh, we must have the print coming right up. Let's take a look at that. Vol's like off the charts here. Oh yeah, next week. So very elevated short-term volatility. Well, that actually is interesting because remember what we were just talking about, which is that 150 level. And we're basically right there. So if you wanted to play for a bounce off of that, I think that might make some sense. I like the names that you guys are coming up with because, what it sort of illustrates. So I guess if we're looking at fibs, that's a little lower than 150, isn't it? That's so that number, if you can't quite make it out, that's 137. I'm going to round to 80. Call it 138, $138. So, and vol's high, so you could probably think about that as a number to shoot against for your put sales and stuff like that. Google, KJ Lemur. Google held up really well on the CapEx versus cash flow. Amazon blew it out and dropped. Great call last week. Good analysis on CapEx versus cash flow. So, yeah, it was interesting. Alphabet just announced that they are doing a bond offering. They're raising some additional cash. I think that news did that come out today or yesterday? Sometimes things blur together a little bit. So did I read that yesterday? Did I read that today? But I read it. This was, let's see. So Alphabet set to raise, did I say 15 billion? I don't know if I gave you a number. 20. Oh, look at this. People love this, huh? Massively oversubscribed. So they're looking for 20 bids for 100. Okay. In their case, they're generating positive free cash flow, net of CapEx, and substantial positive free cash flow at that. Yeah, KJ, to your point, it was oversubscribed. As we just saw, it was 5 times oversubscribed. So, still good. Yes, okay. Tucker D. Dog. DocuSign got multiple years growth compressed into the pandemic when everyone worked from home and had to e-sign stuff. True that. And it's priced like it, right? I think at this point it is not a question of whether increasingly that is how things are going to be done. We're not going to revert back to, okay, everybody's got to come up with a piece of paper and come into the office and sign. We're only going in an increasingly remote and electronic direction. The question is whether they're going to start getting pressure from other corners and fronts. And I think that's certainly possible, but it is certainly priced with a lot of bad news. And, it reminds me a little bit of Zoom. And, Zoom ended up with more than 30% cash per share. And I think it actually did end up catching a bid. I think I pointed this one out too. We were looking at it a while back. It got really quite cheap. And it deservedly, because people would say, well, they've got more competition and there's a lot of other things that aren't so great. But eventually people recognize that, with that much cash, you really, it had a lot of credibility when you got that much cash on the balance sheet, and they had a ton. And this proved to be a great buy. So similar sort of story, absolutely fueled by the pandemic, competition from other areas, a lot of potential growth compressed into a short interval, and it was not going to get back to those levels of growth probably ever again. But that sentiment, and I don't, I sometimes wonder, is it because you have growth players that are rotating out, and that's what causes these things to get oversold? I don't know, but it does happen, and I think this was another example of it. Michael Anthony, I bought PAGS that has a PE of 8. Is low PE that pays dividend each quarter of 12 cents that's been getting a few upgrades last week to 14. PAGS. PAGS was actually the badge of a natural gas options trader that stood near me on the New York Mercantile Exchange when I was in the natural gas options pit. And a lot of time, and unfortunately I don't remember his name, we just knew each other by our badges. And PAGS was a market maker like me, so he was making markets in natural gas options, and and PAGS became a broker. And the reason that was something that I remember so well, even 24, 25 years later. We don't have this anymore because we don't have the open outcry floors. But in the days of the open outcry floors, and these were real open outcry floors, I mean real yelling, real screaming, you could tell by talking to somebody when they came off the trading floor, just by talking to them, you could tell whether they were a trader or a broker. And the reason you could tell the difference between the traders and the brokers was because all the brokers' vocal cords were destroyed from screaming all the time. We traders didn't yell as much as the brokers, because the brokers would represent orders, and we could say buy them, sell them, we could give hand signals. We would yell, of course, but the brokers were the ones that stood around the outside of the ring, with their orders, and were constantly reflecting them. So they were screaming all the time. And they talk like this. Because their vocal cords had been completely blown out. And I can tell you that it was because of this guy PAGS that I realized that it didn't take long. Why? Because PAGS started as a market maker and he became a broker. So he was a trader, but then he was a broker representing orders. And, 3 months in, he just sounded completely different from screaming all the time. Of course, it's all electronic now, so it's moot. But anyway, KJ. So you're. Sorry about that. I just went off on a little tangent about some guy with a badge named PAGS that you guys don't even care about. Let's take a look at PAGS. This looks like it might be a small one again. That's not that small. 20 billion in revenues. So we do have this thing I was just talking about, which is a little troubling, which is that we're watching the growth rate slow. Right? So we had in 24, we had almost 18%. Last 12 months, that had slowed to just under 12. For the full year 2025, cut in half, more than cut in half from the prior year to 8.4. And next year, the street is actually looking for this thing to see declining revenues. Were there any corporate earnings going up? 12% year-on-year growth. That's good. What is the cash flow situation? We have no free cash flow forecast, but let's think about it. Ooh. What's going on here? So why is EBITDA coming in so hard? So we had 52% gross margins in the trailing 12 months, 50% thereafter. Why are they expecting so much margin compression? So still profitable, but no free cash flow. You guys know that free cash flow is one of my favorite things to look at. So I don't know this company. Perhaps there are others among you that do. What is it that they're up to, and why are they seeing such significant margin compression? So and when do they report? That's the next question we want to know. So they're going to, first week of March. Has not responded all that favorably to the last several earnings reports. Have people been lowering their estimates? Not really. So right now, I mean, there was one small adjustment just recently. Adjusted EPS estimates for the fourth quarter got as high as just over 230. They're 222-ish now. Is that right? Let's see what we have. Just because they're going to be reporting soon. Oh, yeah. Okay, so that number was as high as 230. It is significantly lower than the year ago period, as we can see here. How much has this stock been beaten up as a result? I'm not sure. It hasn't really. Obviously off a lot from where it was. Was this some kind of a pandemic darling? I'm sorry, I don't actually know the company. And since I don't know what they do, it's kind of hard for me to opine. I'm going to have to take a look at this one. If somebody who's in my ear and listening and recording is able to just make a note that I need to get back to this one. I mean, this was a profound growth story. It's a big company, had massive free cash flow, or is it, so it's certainly interesting. If this was a sustainable number, even with just a reasonable growth rate, if this was a sustainable number, I would say, for sure, I'm all about it. But there's something else going on here. One of the things that's going on is that we need to adjust this. There we go. Okay, so it is there. That makes more sense. All right. I'm going to have to take a look at that one, Michael. Monday morning quarterback. Pags has competition for... Yeah, okay. This is good. From Mercado Libre. Makes sense. And yeah, I should familiarize myself with this story a little bit more because it seems like an interesting one. Obviously, Mercado Libre is a more consistent story, a faster growing story, and it's a much bigger company. So if they are indeed competing with one another, it's tough. You kind of want to buy the best of breed, and it looks like it's priced that way. Let me just see if Bloomberg just drops them into the same bucket. They didn't in that context. Let's look this way. Okay. I owe you more work on that one. Better for me to do a little bit more homework than to just spit stuff out on a business I'm not familiar with. And with that, I have taken up, hopefully not wasted, used up an hour of your time, but I hope you found it somewhat interesting, somewhat helpful. And we are going to do office hours tomorrow. So we've been trying to identify a time because Professor Mark Guthner, his class schedule this semester is a little bit different. So the time when we usually did it, he's actually lecturing at that time. But we found a slot, which is going to be, maybe someone can confirm in my ear, but I believe it's going to be 2 p.m. Eastern time tomorrow. 2 p.m. Eastern, if for those of us who are on the West Coast, 11 a.m. We're going to be doing office hours. We'll be taking your questions and talking about a couple things that might be interesting. And we've missed chatting with Mark in any case for a little bit of time. So until tomorrow, like, subscribe, throw your comments into the comment section. I have a little bit of homework to do as well, but hopefully you'll be able to tune in for office hours. And if not that, be sure to tune in again on Wednesday, 4:15 Eastern time for another open mic. Thank you for watching.